Hey guys, what's happening? Wanted to just go over some things that I think that are holding a lot of traders back, and they're really not aware of it. And I see it a lot in trading chat rooms, etc. People will post stocks, and I'll look at the charts, and I say, "Oh, they're going to get slammed." Maybe they're posting a chart where the prices haven't even broken out of the second cat line yet. They're still in the first cat line, the cycle adaptive trend line, and so they post it. The prices pop for a few days, and then they roll over pretty sharply, and people wonder what happened. It's hidden cycles, and I didn't know about these cycles myself until several years ago, after just going back and forth through many charts, and eventually just doing a bar count, basically counting from a pivot. So it looks like this here. We're basically wrapping this around price. We're looking for one side of the consolidation to be, whether it's a couple days or a couple weeks, depending on what time frame you're on. We put the U pivot there, and we do a cycle count, bar count, etc., based on cycles, and then we draw trend lines based on that. Again, we're looking for three trend lines, Cat 3, generally in a consolidation zone, depending on how far the prices are pulling back from that U pivot. So it sounds like a minor thing. I mean, why would that be a big deal? Where you put the pivot and drew trend lines off of it. It's critical because you don't want to have dead zones in your trading. If you're an aggressive momentum trader where you want to maximize your account equity growth, you want to have the edge of timing. Timing is so important. You actually, and I know a lot of traders who do this where they have a great stock they like for great fundamental reasons, whether it's new technology or something like that, and they get kind of attached to it, and the prices spike up very nicely, maybe too much, and then they pull back sharply. I mean, like dramatically sharply, like 50 to 75% from that U pivot high, and then they'll buy it within month or two, and because they went back in it, they think they're getting a great price. But the problem is they're inside of cat line number one, cat 1, and generally speaking, depending on how deep that consolidation is, it could be anywhere from 2 to 6 or 7 months before the prices take off and have any significant move off of that original pullback price. So you get 4 to 6 months plus where your money's not working hard. Again, our type of trading is not only picking the stocks that have the potential to move very far, very fast, but they eliminate a lot of those dead zones just based on stock timing. So it's really critical, and those cycles are not only applicable to stocks but also to indexes. In fact, I'll show you a chart here. Let me just go ahead and show you that first. Okay, here's how the cat line's set up on the index. Dow Jones 30, the market shakeout late 2018 was quite predictable based on the index cat cycles. TY1 formed 2010, TY2 in late 2011, and you had TY3 set in 2016. The extension channel of that TY3X, you can see very close to the exact area of that. Now, what happened late 2018 was you had a failed retest of that. Try to take out that high, no luck, and can't go up. You got to go down. That's what happened. Real harsh shakeout, but that was a result of cycles that it was targeting, and whether or not it recovers quickly or not, that's questionable. I think we'll get. I would be surprised if the Cat 3 trend line was up here, close to that. I mean, it's coming off the bottom strong. This is February of 2019, but it's tough to tell right now. Either way, you're going to get a Cat 3 probably before you get major fall through, and that could be months out. So our type of trading is all about turning down the noise and paying attention to those cycles, and ignoring all the buzz around a stock if the cycles in fact are not playing out the way they should be. We're not randomly just buying a stock because it's got great news, etc. We want to be really paying attention to the cycles in the price action. We don't want to buy a TSS set, a Cat 2 Trendline set, and get slammed when the prices roll over. So we definitely pay attention to that. Also, the pattern quality. Pattern quality is really important. And high quality, high momentum stocks with excellent pattern quality are more likely to follow through. We don't want to be randomly buying stocks just because they have some momentum and maybe a good story behind it. Again, we want to pay attention to how the pattern quality unfolds, and pattern quality is just basically a reflection of what other traders think about a stock, and if they are propping up the stock on pullbacks and consolidation zone. So the quality of the fundamentals is oftentimes written into price action, and what other traders and investors think about the stock's potential can be telegraphed if you know how to read it. So, for example, the depth of pullback after a consolidation or after a price spike will tell you a lot about whether the stock is going to get followed. And there were plenty of examples in the past year with what we call patterns, which are millionaire maker patterns, and they're basically stocks that have had a really strong momentum breakout and then a very soft landing pullback in a consolidation zone with very short cycles on the TSS set. And in some of those cases, the actual cat line setting up may max out at 2. And that's a really good sign of strength, especially after a big run-up. So we really pay attention to a lot of those types of stock. And again, we're always focusing on stocks that have had strong stage 1 breakouts, and we're looking for stage 2 pullbacks in anticipation of a big run for the final part of the super cycle. So I hope I haven't bored you too much on this whole dead zone thing, but it just is so important to really maximizing your overall annual gains on stocks and being able to take the money from one trade and to put it into another. And also having an understanding of these cycles is how you build stock scans around. In fact, we have some very powerful scans all based on these cycles and taking advantage of the U pivot and based on the cycle length, etc., we can target stocks that are printing those cycles and pulling back off of those trend lines. So we basically build monster stock holding ponds. We can be 1 to 2 months, maybe even 3 months ahead of the curve on a lot of these, and whereas many traders will not even be aware of them until they had an actual breakout. So it's one of the advantages of having an understanding of these cycles is that you can really get a head start on stocks that have the potential to break out of those cycles pretty strongly based on how they performed previously. So, and the other part of that is that these cycles are not disconnected from prior areas where they broke out. In fact, when you get a stock that broke out 3 or 4 years ago and is pulling back inside of a yearly trend line, a TY3 trend line, that's really something that can create some strong breakouts. And a lot of traders just don't pay attention to those long-term trend lines, and that's one of the things we really take into account when we're going through charts. We look at the not only the daily, we look at the weekly, monthly, etc., and look for the potential for those long-term breakouts, because they can have some explosive effects. And why would you want to be in slow trades when you can be in these high price tension, price squeeze breakouts built around long-term cycle breakouts? So as with all this, if you have inferior timing combined with inferior stock selection, you're going to have inferior account growth. So not only do we have superior timing based on these cycles, but we also have superior stock selection strategies. And just to give you an example, there was a stock last year, PRQR, was a millionaire maker pattern. It had one particular pattern that we used for that type of trade, and the stock went from $8 to $22 in just 1 week. And again, this is based on a key cycle. It's actually 2 cat lines forming this particular cycle, and it's one of the better trades that we have, just because the consistency is they're just based on the fact that it demonstrated extremely good pattern quality. And like any stock that has great pattern quality, generally reflects what the insiders, the traders, investors think about the fundamentals of the company. So again, price action is a great predictor of where a stock is going to. Sure, you can look under the hood at the not only the fundamentals but the story behind the stock. But the one thing that I've consistently seen that will tell you a lot more about what will actually happen versus what the insiders and other people think is price action and great pattern qualities. Okay, that about wraps it up. Hope you enjoyed it. Hope I didn't get too much into the weeds on it, but I really wanted to explain the big picture of why a cycle-based approach to trading is important and how it can improve your trading results. If you would like to test the waters and see what the Big Kuna Trading Club is all about, I'd encourage you to take advantage of the offer you see below this video. We'd love for you to come check us out, ask questions, and get a better feel for how our system can help you find and trade some of the rogue wave stocks you've seen in this presentation. Hope to see you on the inside. Take care.